In 2016, Joel Monegro introduced the FAT protocol, Thesis, which fundamentally shaped how investors viewed value accrual in crypto networks. As we approach 2025, with modular blockchains, Layer 2 scaling solutions, and MEV extraction becoming dominant forces, it's time to re-examine this influential framework and determine if it still holds true, or if the reality has become more complex than we initially predicted. Our agenda today will trace the value flows in modern crypto, starting with understanding the original FAT protocol, Thesis, validating it historically, and identifying modern challenges. We'll propose a new framework and discuss investment implications, aiming to provide a comprehensive reassessment of one of crypto's most influential theories. The FAT protocol, Thesis posited that the Internet stack protocols were essential infrastructure but captured minimal value. In contrast, crypto protocols were expected to capture significant value, as applications built on top of these protocols would become valuable primarily through tokenization. This created a value asymmetry where foundational layers remained THN while applications became FAT. The thesis was groundbreaking because it reversed traditional technology investment logic, suggesting that protocols would be the primary value capture points in Web3. It identified that crypto protocols benefited from powerful network effects and token economics, creating a layer that captured value despite their importance. Between 2017 and 2021, the market performance of Layer 1 protocol tokens significantly outperformed most applications. Ethereum and Bitcoin maintained dominant market capitalizations, validating the thesis that foundational layers accrue more value than applications. This performance aligned with Monegro's prediction, showing that even in competitive environments, Layer 1 tokens held their ground. Several mechanisms reinforced Layer 1 dominance, including economic bandwidth, market liquidity, regulatory clarity, ecosystem leverage, and security budget. These factors explain why Layer 1 tokens maintained their dominance and seemed to validate the FAT protocol thesis, as they attracted more investment and created a strong base for applications. Technological and economic developments have emerged, challenging the straightforward FAT protocol model. The rise of modular blockchains, Layer 2 scaling solutions, MEV extraction, and new token models suggest a more complex value accrual pattern is forming, indicating that the crypto landscape is evolving beyond the original thesis. Layer 2 solutions like Optimism, Arbitrum, and Solana are well positioned to scale solutions for Ethereum, capturing significant value. These solutions have demonstrated their ability to enhance transaction speeds and value capture mechanisms, challenging the notion that Layer 1 protocols are the sole value holders. Liquid staking protocols like Lido and Rocket Pool insert their tokens into the ecosystem, capturing portions of staking rewards and adding a governance layer above native staking. This represents a fundamental challenge to the FAT protocol thesis, as these protocols create new value capture layers between users and the base protocol. MEV, or maximum extractable value, represents a significant source of blockchain value that often goes unnoticed. It involves opportunities in trading protocols and sandwich attacks, creating a new layer of value capture that challenges the traditional thesis by extracting value from specialized actors rather than token holders. Cross-chain bridges have emerged as critical infrastructure, enabling seamless value flows across blockchain ecosystems. This suggests a more interconnected ecosystem where value flows across protocol boundaries, challenging the notion that value is captured exclusively by individual Layer 1 protocols. Applications have developed various strategies to capture value, despite operating in an open-source environment. Many applications now generate more direct revenue than their underlying Layer 1 protocols, indicating that the application layer is maturing and capturing significant value independently. Rather than a simple dichotomy between fat protocols and thin applications, the modern crypto stack is evolving into a modular value stack. This stack focuses on value capture mechanisms and tokenomics, indicating a more distributed pattern of value accrual than initially predicted. Layer 1 value proposition is increasingly focused on providing foundational security and credible neutrality, rather than capturing all transaction fees or application value directly. This specialization has implications for how Layer 1s are valued, emphasizing their role as the ultimate settlement assets and revenue sources. The distribution of value in the crypto ecosystem has evolved significantly since the original FAT protocol, Thesis. Specialized layers have emerged to capture significant value that wasn't expected in the original model, indicating a shift towards a more complex reality where value is captured in multiple specialized layers. The modern FAT protocol, Thesis, suggests that value accrues to layers with economic bandwidth, the ability to process, secure, and settle transactions with specialized features. This updated framework focuses on specialized layers as key value capture points, rather than solely on base protocols. Investors should consider a diversified approach to crypto investing, focusing on layers with economic bandwidth and strategic features. This approach suggests that investing across the stack may be optimal, rather than prioritizing base layer protocols as the crypto ecosystem evolves. Ethereum, Arbitrum, and Lido have demonstrated significant value capture across different layers of the stack. These case studies highlight how specialized layers can capture and retain value, challenging the original FAT protocol, Thesis, and showcasing the evolution of value accrual in crypto. The evolution of the FAT protocol, Thesis, shows a shift towards specialized layers based on their unique functions and competitive advantages. Applications, middleware, and cross-chain solutions have proven themselves as significant value capture points, indicating a more complex reality than initially predicted. As the crypto ecosystem continues to evolve, investors face strategic questions about consolidation, MEV redistribution, app-chain proliferation, and real-world asset integration. These questions will shape investment strategies and reinforce the value of specialized layers in the future.